I'm going to be a very studious student and I'm going to study all these books in detail in the next 4 months and go fully prepared for the exam. Uh, I am going to read at least these books and go kind of fully prepared for the exam. At least 21 most likely should work for passing, right? Hey folks, Rachana Ranade here and I welcome you all to a brand new video which is about how to save your taxes legally. Why did I say that? Please understand, when it comes to reducing your taxes, there are two words which come into picture. One is known as tax avoidance and one is known as tax evasion. If I'm using the word tax evasion, this is something to do with illegal stuff. Okay, so we are not going to discuss about this. What we are going to discuss about is tax avoidance. Never done this, I guess, but let me try it out. Once a child asked his elder brother that how much is 2 plus 2. And the brother was like, maybe 4. Then he went and he asked an engineer, dude, how much is 2 plus 2? He said, obviously 4. And then he went to a chartered accountant and he asked that how much is 2 plus 2? And chartered accountant said, how much do you want? So it is said that CAs are the ones who are very good at playing with numbers, but we are talking about playing with numbers in an absolute legal manner, right? Who allows us to avoid taxes? Our government. Our government has given a set of sections which allows us to reduce our taxes legally. Which are these sections? They range from section 80C, 80D, 80E, and so many more. Even if I don't talk about 80 section, we have 24A, 24B, and a whole bunch of other sections. What are we going to focus on today? We are going to focus only on one section today. It's a crash course, na? So only one part and small part. So 80C section is what we are going to focus on. Again, please pay 100% attention. 80C section, I can say, is broadly again divided into two parts. One part of that says that you spend some money and you get a deduction from taxes. Okay. Just as an example, you pay the tuition fees of your child and get some deduction. Or it could be you spend some money on repayment of a loan and you get some deduction. But again, we are not going to talk about this. What are we going to talk about? Invest money and then get a tax reduction. Well, let's understand that whether it is mandatory for a person to go ahead with the tax saving option. No, it's not mandatory. So, just as an example, I as a person, I can say that I don't want to save on tax right now. I don't want to invest my money. I want the money with me. I'm ready to pay some amount of tax. But balance will be my disposable income. I'll spend it the way I want to. Okay, that is option number one. Option number two is either he spends it or he saves it as per the laws and then he gets a tax deduction. Okay, so I hope you have understood two concepts. Availing exemptions, availing deductions is not mandatory. A person can decide whether he or she wants to go ahead with it or not, right? Now, if I'm talking about tax saving options, is this a very new concept? No, not at all. It has a long history. Once upon a time, there was Captain Russell and there was a person known as Bhuvan. If you remember, Captain Russell had given two choices. Either you pay 3 गुना लग 2 गुना लगान या फिर 3 गुना लगान देना पड़ेगा, or you have to play a match and win the game. An SSC at that time was also given two options. So I hope you've understood that it dates back long in history, and that's what we have been continuing till date. Enough of jokes, enough of history. Now let's get down to business. Let's try and understand which are the 5 investment options which are available under section 80C, which will give you tax saving options. There may be many more than this. So other than these 5 that we are going to discuss today, do let me know which ones do you use for tax saving options. The very first one that we are going to discuss is ELSS, which is Equity Linked Savings Scheme. The second one that we are going to discuss is Sukanya Samriddhi Yojana. The third one that we are going to discuss is PPF, which is your Public Provident Fund. The fourth one that we are going to discuss is the National Savings Certificate. And the last one is your 5-year bank deposit. Right? So all these 5 we are going to discuss in today's video. And there'll be many people who will be like, done, we have got all 5. So for those who are here only to know tips, for them, Jai Hind and bye-bye. But for those who are interested to know more, who are interested to learn more, we are going to talk about all these 5 options in depth in the coming parts of the video. So what have we done? We have tried to, list down all these types of 5 investment based on their returns in a descending order. So the first one that we are going to discuss has a potential to give you the highest possible return. To the fifth one will possibly give you the lowest possible return, right? So first one is equity linked savings scheme. So what does this mean? Equity linked saving scheme, whatever money, so it's kind of a mutual fund, right? So mutual fund investment type hai. So if you invest money in a equity linked saving scheme mutual fund, the fund house will have to invest minimum 65% in equity. Balance can be in instruments like debt. As I mentioned, it's minimum 65%. So can 80% go in equity and balance 20% in debt? Yes, possible, right? Second important feature of ELSS is that it has a lock-in period of at least 3 years. So you can't withdraw money before 3 years. Third one is taxability. Okay, so just as an example, if you are earning only 20,000 rupees as a long term capital gain, is that exempt? Yes. Up to 1 lakh it is exempt. Over and above 1 lakh long term capital gain will be taxed at the rate of 10%, right? One more point is that the minimum investment that is required for ELSS is 500 rupees. Okay, but wait, very, very important point. Are the returns guaranteed? No. It's a market linked product. So if the stock markets don't perform well in the short run, you may also have negative returns. Okay, but all in all, at least with 3 years lock in period, I may say that the probability of you generating higher returns is surely more. Well, an amazing announcement for you all. As I'm recording the video, we have not hit 2 million, but when this video will be released, we might be like crazy close to 2 million, or maybe we might have crossed 2 million. I'm not sure. So based on that, just to share the happiness, what I'm going to do for all the pro investor members is that I am going to discuss ELSS absolutely in detail live on this date at this time. So don't miss out the session. Also, one more announcement that I also have a course on magic of mutual funds. So just in case if you're not a pro investor member but you have already enrolled for the magic of mutual fund course, we will upload this live session for you in the course itself. So if you don't have, if you have not enrolled for the course, you can check out my website rachanaranade.com. If you have not yet enrolled for memberships, you can just hit that join button. So let's move on with the next one, which is the Sukanya Samriddhi Yojana. In this, the whole purpose of the government was to promote the girl child, wherein the expenses either relating to her higher education or relating to her marriage should be taken care of, and that is why they promoted the Sukanya Samriddhi Yojana. Yojana is a scheme. In this, either the natural parent or the legal guardian is allowed to open an account in the name of his or her girl child. Maximum one account can be opened in the name of the girl child. So assume I have a girl child. Can I open 5 accounts in her name? No. Okay, only one account per child. And maximum for 2 girls, you can open an account. So example, a person has 3 girls. He will be allowed to open Sukanya Samriddhi Yojana account only in the name of 2 girls. Basics clear, I hope. Next few points, important points are: when can the account be opened? Maximum till the girl attains an age of 10 years. Next important point is that the lock-in period here is a little bit different. Lock-in period is at least 21 years age. Whose child is not girl child's age is 21, or marriage, whichever is earlier. That is where the lock-in ends. Next point is important is that whatever interest you're going to get on that deposit, that is going to be absolutely tax free. No tax on that. Even no tax is there on the withdrawal as well. No tax on maturity as well. Current interest rate is around 7.6%. This is compounded annually, and these rates fluctuate or are reviewed, I can say, on a quarterly basis. Okay, so as I'm recording the video, it is 7.6%. Okay, can the rate change next quarter? Yes. Next one is that that a partial withdrawal is allowed when after the girl attains 18 years of age for either marriage or for her higher education. And the last one is that the minimum investment required for this one is rupees 1000. Well, the next one is PPF. Who can open a PPF account? Can a salaried person have a PF account, and can he also open a PPF account? Answer is yes. For a person like me, I earn 0 rupees salary, but can I open a PPF account? Yes, allowed, right? So any resident individual can open such an account. HUF, Hindu Undivided Family, cannot open a PPF account, right? Let's go to the features directly. Features are that the current rate of interest is 7.1%. Again, this rate is reviewed quarterly. So can this change in the next quarter? Can change. Second point is that interest earned, whatever interest we earn, is tax free. In fact, whenever you withdraw the entire amount also, that is tax free. Third one is it has a lock in period of 15 years, but you are also allowed to extend it with a block of 5 years. Means what? Let us say, by the way, currently my PPF is running in its 12th year, if I'm not mistaken. Once 15 years are done, can I extend it directly for another 15 years? No. I'll have to first extend it for 5 years. After that, again 5 years. I hope you understood my thought process. Next one is that I'm allowed to partially withdraw the money after 7 years. Okay, so partial withdrawal allowed. And the minimum investment here is 500 rupees. Well, moving on with NSC, which is the National Savings Certificate. This is also a scheme which is backed by the government and it is available at all the post offices. So earlier, when we didn't have easy access to internet, this was a scheme which was like very popular. Why? Because it was available at each and every post office. And I hope everyone knows that the penetration of post offices in India is very high. But as and how we got an exposure to internet, we got the ease of investing. Then this specific NSC category of investment is slowly losing its sheen. But if I were to talk about its important features, let's understand that it has an current rate of interest of 6.8%, and of course, this is also tax free. You might say, Rachana, you just talked about PPF right now. It had 7.1% interest. Why should anyone even think about 6.8% interest? Because PPF had a lock in period of 15 years, but NSC has a lock in period of only 5 years, right? Next one is that annual interest is payable at maturity. Then there are no premature withdrawals allowed. Anyways, it's only 5 years now. Usme bhi kya premature withdrawal? But then, if there is a death or if there is a court order, then premature withdrawal is allowed. Minimum investment here is 1,000 rupees. Well, before I move on to the next one, I would like to tell you one important point. The three investment avenues that we discussed right now, one was PPF, one was Sukanya Samriddhi Yojana, and one is NSC. All three have a common feature. All these three investments are backed by the government. So, like just as an example, if I put some money in bank FD, can the bank shut down? Can the bank liquidate? Yes. But these three are like rock solid. Your capital is absolutely intact, because then it would be like saying that what if government defaults? That's as good as not possible. So I hope you have understood the key feature of all these three investment avenues. Well, let's move on with the last one, which is a 5 year tax saver FD. Now, what is the key feature of this? Key feature is that, as I mentioned, lock in period of 5 years. Second one, interest is taxable. Whatever I discussed till now, which was either be NSC, PPF, or even Sukanya Samriddhi Yojana, for all these schemes, interest was tax free. This one is taxable, and then you can imagine the rate of interest is only 5 to 5.5%. So, एक तो मिल रहा है 5.5%. On that, it is taxable. So, I feel doesn't make a lot of sense. Anyways, one more feature just to add up is that one time lump sum deposit is allowed. So, this one is not applicable for an RD. Recurring deposit is not allowed. It's a 5 year tax saver FD. But I hope you have understood. If I compare NSC versus a 5 year tax saver FD, for both lock-in period was 5 years, but year interest was tax-free. Year interest is taxable. Then why not go for NSC? Because then going to post office is a big headache. Now that is why people choose FDs maybe. But I hope you have understood where interest rate is higher. Well, let's move on with the maximum permissible amount of deduction under Section 80C. Let's take an example. Assume that I had invested 1 lakh in a tax saver FD, 1 lakh in Sukanya Samriddhi Yojana, and 1 lakh in PPF. Okay. How much is the total amount of investment? 3 lakh. But what is the maximum permissible deduction? It's only 1,50,000. So in this case, even if I invest 3 lakhs, the amount of deduction that I'll get for tax saving purpose is only 1,50,000. Now let's have a quick recap. Now you can see these are the 5 types of investments that we discussed. I've arranged all these 5 in a descending order of return. So highest one is for ELSS, somewhere between 12% to 15%, and lowest is the 5 year bank FD. Lock-in period is also lowest for ELSS, and for PPF it is the highest. I can also say for Sukanya Samriddhi Yojana it is also like highest 21 years because. And then if I talk about tax returns, you can see that 5 year is fully taxable. For ELSS is going to be partially taxable, and for the balance 3 it is no tax. So all in all, just to sum up, I hope you can easily understand that if you are a person who can take a little bit of risk, ELSS is clear cut a winner amongst these 5 options. Well, if you want to understand as to how to analyze ELSS in the most detailed manner, that's what you have to do. You have to attend this live stream. But till then, take care, Jai Hind, and bye bye.